So Martin, thanks for joining us.
Oh, pleasure.
I might get a glass of water too. I've got quite a choice of glasses here.
Yeah, you've got to try and find one that hasn't been used.
Yes, exactly. That's the trick. That's the trick. The transparency is not helping me in this one. Great. So I want to start our conversation today just by understanding why did you invest in Asset Co? Why did you become its chairman? You had an absolutely fantastic career at Aberdeen. When you sold it to Standard Life, I think it was the biggest asset manager in the UK. And now you're starting over, acquiring really interesting businesses. What drove you to do that? What are you trying to do?
I don't know. Maybe I didn't know what else to do. I was going to when I left Aberdeen, which I mean. I can assure you that everything you've heard about life companies is true, by the way. So it is, and governance and risk at life companies are the worst thing I've ever been subjected to in my career. So anyway, I couldn't get out fast enough, really. So and then I got approached by about 8 banks asking if I wanted to do a SPAC. So I thought there must be something wrong with the SPAC market when 8 banks all phone you to ask you to do one. So I thought, I don't really fancy that. And then I was approached by Jonathan Punter of Punter Southall to say, look, I've got this really awful investment, which has gone down 70% in value at River and Mercantile. Would you come in and sort it out? So I said, yeah, I'll do that. And so I went into River and Merc, and in the interim, someone suggested we do a cash shell. So I put the River and Merc stake into I bought the stake in River and Merc. I put it into the cash shell. And then, yeah, look, I love the business. I mean, asset management's the best business in the world. So, you're doing a great job for your clients, you hope. So, yeah, and I was fortunate that a lot of my colleagues at Aberdeen also decided that a quasi-life company was not the best place to be, and came and joined. So yeah, it's been good fun. And yeah, I mean, we're not interested in building another Aberdeen. I mean, that took 34 years, and we built a global business in those 34 years. So I'm not planning to do another 34-year career. So yeah, no, it was great. Look, it's been great fun.
I thought because the annual report from Asset & Co, I think the theme of it was, and I can't remember the exact words, sorry, but it was delivering value to customers, to investors and shareholders, which that dual theme is so important. And I think we often forget the customer in these listed businesses and focus on the shareholder too much.
Yeah, I mean, I think that's one of the downfalls of being listed as an asset manager. You're under this constant, pressure to deliver flows. So often people say asset management businesses shouldn't be listed, and I have a lot of sympathy with that. But if you're trying to build an asset management business as we are by a mixture of organic and inorganic growth, you need that share capital. And I mean, Aberdeen was built by a mixture of both. I mean, we did 60 acquisitions over those 30-odd years. So we built by both methods. But there's no point doing acquisitions unless you're growing organically as well, because the money will just sort of flood out. So, yeah, no, it's a great business. Most people screw up acquisitions in the asset management sector. So it often amuses me when big asset managers, foreign asset managers, do an acquisition, because I can tell them they're going to mess it up. But
so what is it? What would you tell them?
Don't do it. I mean, leave it to me.
I was going to say, they'll drive down the prices for you.
Don't mess up what we're doing.
So you've mentioned that you're not trying to do another Aberdeen.
Yeah.
What are you trying to do?
I don't know. Just build an asset manager for what I look to the future and have various themes. So what we see is long-only asset managers severely undervalued at the moment. Private market asset managers severely overvalued at the moment. We want to be in thematic ETFs because of, so we bought Rise. We own a bit of Parmenion, Martin Jennings' outfit. So we wanted to own more, but Aberdeen were clearly not going to sell the business to us. So we ended up with 30%, so we like that business. Private markets, we want to build rather than buy. So the two big areas there are obviously infrastructure, private credit. Those are the sort of really hot spots at the moment of private markets. So look, as you know, I mean, there's a massive shift in asset allocation happening globally from public markets to private markets. So it's about 5%. But I mean, if you go to Canada, some of them are already at 50% in private markets. So it's that theme that we're really trying to get on the back of, plus severely undervalued long-only asset managers. And you heard in the previous panel that actually active alpha is still a fantastic area to be. So we try and buy good asset managers, small asset managers, boutiques, who are really good at managing the money, but poor at distribution and poor at running their businesses. Because I'm sure you all know this, asset managers, CEOs are either distribution-led or investment-led. So it's very rare. I'm both, by the way.
Okay,
just
I was going to ask.
No, I'm a rare. So we try and identify investment-led asset managers because they tend to be very good at what they do, but they're very poor at distribution. Because a good fund manager thinks his fund, as all of you know, the good fund managers think their funds should sell without being sold. So we try and get on the back of that theme as well. So it's quite simple business as long as you stick to what you're good at. And look, we've tended to make every mistake it's possible to make. So hence in the 60 acquisitions. So that's why I say to people, you shouldn't do it because you haven't made the mistakes that we have over that career.
Yeah. I want to come back to a couple of things you mentioned, but first we should talk about Revolut, because you're also chairman of Revolut, which is a really, really interesting business that does money transfers. It does crypto. I hesitate to say investing. They're launching a wealth management business of some sort. So tell me a little bit about that business.
It's, I mean, I think it's refreshing to go from I'll call it Standard Life Aberdeen. It's now called Aberdeen, as you know, but we couldn't call it Aberdeen, so we have to call it ABRDN. So, to go from there to Revolut is like, I mean, it's like incredible. I mean, fintechs, their motto is, they've got this great sign, which the regulator hates, by the way, which is great, and then it's got shit done. And they take the SH out, so as far as the regulator sees, get it done, And that's its motto. It just gets stuff done. And the growth is unbelievable. I mean, they're putting on hundreds of thousands of customers a week. I mean, bear that in mind. Just think, the scale of putting on a couple of 100,000 customers a week. I mean, just the systems you need and all of these sort of things. But just to put that in context, Spotify puts on 800,000 a week. So, the growth in these fintechs is just phenomenal. Nubank, I think, is about 500,000 a week. I mean, these are just incredible. So it's all about growth, basically. And it's fantastic. So Nikolai, who's one of the most driven individuals, he was portrayed as Russian, but he suddenly found his Ukrainian parent. His father's Ukrainian, so that's good. The other co-founder's Ukrainian as well. So they're the most driven guys you've ever met. But he wanted someone as chairman who'd founded a business. So he and I met and we discussed it. And I just went through all the mistakes we'd made, and he said, "Look, that's great. Come and help." And it's been good. Yeah, it's amazing.
Great. Definitely a contrast.
Regulators are a problem, though, so it's the same theme, everywhere, So.
Well, that was one of the questions I was going to ask, and that was something that Richard, you asked Peter this morning about how we engage with the regulator, and I'm interested in, in terms of how we should, when we're thinking about the theme of the conference is reimagine wealth management, and a lot of the conversation has been about how we feel impeded sometimes to reimagine what we're doing because of regulation. How do you think we should be engaging with the regulator?
I think you've just got to engage a lot with them, especially if you're a Revolut, because you're really, really prominent. It's the UK's leading biggest fintech. I mean, just to put it in perspective, I was speaking to the Irish regulator, and she said to me, "You've got to understand that you have a bigger market share in Ireland than all the banks put together. So we would be looking at you very closely." So it's these type of penetration rates so regulators take an inordinate amount of interest. They also take a huge interest in crypto because they still think that it's a conduit for organized crime, which I think is quite difficult for organized crime to get money into the system. But what they're most worried about is vulnerable customers putting a large percentage of their wealth or savings into crypto. And bear in mind, there are more people in the UK own crypto than own shares. I mean, we are speaking about a serious issue here. So that's what regulators are really focused on there.
Yeah.
But you've got to just speak to them. That's the key.
Yeah.
Engage.
Yeah, absolutely. I'm looking around to see hands. No hands yet. Okay, I'm coming back to you. I'm going to read this so I don't get it wrong. It's from your annual report.
I haven't read the annual report.
It's in your chairman's letter, so I hope you read the chairman's letter. Not for Revolut, for AssetCo. The industry is contending with significant structural shifts, including technological advances, a reorientation of investment habits, and evolving client needs that will have a profound impact on the business models of many existing asset management and wealth providers, their offerings, and the choices available to clients and savers. It could have been the tagline for this event, right? And when I read that, I thought it was pretty pertinent. So, thinking about, we've talked about adapt, innovate, thrive today. Which parts of the wealth management industry do you think will adapt? Which do you think will thrive? Which do you see most under threat?
Well, I mean, I think the headwinds for the asset management and the wealth management industry are much the same, which is active to passive. We're seeing a massive shift, and we heard from BlackRock earlier. Fee compression. We're seeing the rise of ESG, and wealth managers, like asset managers, are having to contend with this massive shift from public markets to private markets. So those are the headwinds, and you just have to work out how you're going to react to those headwinds, basically. So so for us, so what the big legacy asset managers are trying to do is reinvent themselves by buying private market businesses. So you'll see BlackRock or you'll see Schroders buying private market businesses. But the problem is they're up against the Blackstones of this world. So Blackstone are always going to dominate I think, private market. So it's quite difficult. So hence the reason these public market asset managers are on lower ratings than the private market. So, a public market asset manager might sell for 8 times earnings, and a private market asset manager will sell for 20 plus. And then on acquisitions, we always value asset managers at about 3 times revenues when we're trying to buy. But if you look at private market fund managers, they'll be on 6 or 7 times revenues. So you can see just and that tells you everything you need to know about what's going on in the asset management, wealth management world. And then, of course, I mean, wealth managers have the same problems as asset managers, which is how do they distribute? Do they go, as we were speaking about earlier, the vertical model or whatever? So the problems are the same across the industry. It's how you solve them that's really will decide whether you're going to be successful or not.
So like you, I see demand from customers and asset managers to offer access to private markets. But when we look at our industry, I mean, we heard from Andy Bell this morning, and again, I appreciate, sorry you weren't here when he was talking about this, and Claire Bousfield as well, that from their customers, they don't see much appetite for illiquid assets. They really are looking for quite simple, tradable, liquid assets, and I'm putting words in their mouth, apologies, somebody might be able to correct me on what was actually said. And then we just had Sophie Kennedy from EQ Investors saying that it's not really something that they're looking at. The platform infrastructure doesn't support it very well. And I'm just wondering, where is the place for that in wealth management? Because, I mean, it's for higher net worth, for ultra high net worth customers, they'll put a portion of assets in a fund that will mature in 10 years. And that's a different kind of investment approach than putting 100 quid away every week or whatever it is. So where do private market assets sit in our part of retail wealth management?
Well, if I start at the big institutions, as I said, it'll sit at about 50%. If you take the Canadians, they'll be 50% private markets, and it goes from there down to zero. As you say, ultra high net worth, they'll have a very significant portion of their wealth in private markets. I mean, could be 25%. They've been very, very big buyers of fintech, of these sort of investments, and then you get down to obviously 0% at the smaller end of the retail. But I'm surprised that he says there's no demand for private markets, because normally retail investors follow what institutional investors are doing over a period of time, and certainly we're seeing definitely an interest in private markets. The problem is you're giving up liquidity for enhanced yield. So I think that's the key thing that needs to be explained to investors. You can only put money into private markets that you're prepared to lock up for a few years. And we were speaking about the property open-ended funds earlier. And actually, what we did was we dropped the price 20% rather than close, and no one sold at that price. So I think you can find a market equilibrium, but the regulator hated that and forced us actually to eventually close. So I think then the best models for private markets are closed-end funds or ETFs, because ETFs, as you know, don't need to trade at NAV, so you can actually see the price correction model coming in. So those would be the two wrappers that I would say would suit illiquid markets more. But I think people need to understand that if you tie money up in private credit, it could take you a year or so to get your money back. Or you should put it away for 3, 4, 5 years or whatever. But the ultra high net worth market is massive in fintech. I mean, the amount of money pouring into fintech at the moment is mind-blowing. I mean, Revolut, we did an 800 million raise. I mean, on a 32.5 billion valuation. I mean, these figures are absolutely staggering. I mean, it's why anyone would go public in the UK is beyond me, because you'd be better going to NASDAQ if you do want to go public, or you stay private. You've got more chance of getting money as a private market than you have on the public markets.
Yeah, it's really, it does feel a bit broken. And I remember one of the comments Andy made, so it was about the example of Woodford. And of course, Woodford had sold the holding in AJ Bell before the fund had to close.
Yeah, I mean, Woodford is a classic example of really great fund manager straying from what he was good at and putting illiquid investments into an open-ended structure and breaching all the limits. But I mean, if only he'd stuck to what he was really great at, which is a great income fund manager, we wouldn't have had that. We wouldn't be talking about it today. He'd still be sitting with 25 billion under management or whatever it is. It was a real shame to see that happening. Yeah. And it's bad for the industry, obviously, that we saw that happening.
Yeah, it continues. Whenever I do consumer focus groups, it's always raised. But when I ask about ESG investing, people say, "Well, why would I trust the asset management industry?"
I think that this war is the best thing that's ever happened for renewables. The acceleration in renewable investment is going to be massive in the UK here now because of this worry about energy security. I also think, sadly, COP26 has sort of taken a bit of a back seat as well, because we're seeing a reversal of a lot of what was said at COP26. So we're seeing oil exploration starting again. I've got a house in Aberdeen, so this is all very good news for me, actually. We're seeing more exploration in the North Sea, all of these sort of things. So, I mean, it's had an amazing impact on ESG, actually.
Yeah. Clive, I'm just going to get you the mic, sorry.
Sorry, I should have done that. Sorry.
No, this is my job. And now Clive gets to throw it next time.
Can you hear? Can you hear? I had supper with Jeff Towers last night, and funnily enough, we were talking about the increase in private investment over public, and the fact that the regulator seems to be pushing advisors to stay with equities and bonds in nice, simple funds that they can understand. Is the retail investor going to get marginalised by the move into public? As you say, no sane launch now will be in the public sector. You go private, you make more money. It's much easier. Is the private investor going to get marginalised and be the loser?
Yeah, I think they already have been marginalised because they don't have access to this fast-growing area of the market. I mean, the Canadian pension funds are not putting 50% of their assets into private markets because they think public markets are going to outperform. They think private markets are going to outperform public markets, especially bonds. I mean, so the public bond market is going to be a disaster. I mean, for the next however long, 5, 10 years. I mean, bear in mind, we've had a 50-year bull market in bonds. I mean, it's gone from, I can't remember, 14, 15% to zero over 40 years. It's going to go from zero back up. So as we all know, it's not going to be the place to have your money. And the problem is a lot of retail investors have got money in high yield or emerging market bonds just to get that yield, whereas they'd be better in private markets, but there's no access to it. That's the issue.
What will sway the regulator to change their view? Because they seem terrified of anything
private. They're terrified of daily liquidity funds, basically. And look, they've been grappling with this problem since 2008 on open-ended property funds. And I mean, every time I speak to them, I say, look, you've got to make the decision. We as an asset manager, no asset manager is going to go out on their own and say, look, we're going to go monthly liquidity on a property fund while the rest are all still daily liquidity. That's their main worry is daily liquidity for illiquid assets. So until we solve that problem, they can, of course, get it through closed-end funds. I mean, that is a good area, and that's got a natural price adjusting mechanism because you can get liquidity. It's just the price that you're going to be.
Okay, thank you.
There's also, I mean, there's a lot of pressure from legislators to fund the green energy transition, which will require private assets, and that would have been funded traditionally by institutional money, which there isn't the same amount of institutional money. And I think that's one of the reasons they're looking at the LTAF and workplace as a solution to, it feels like that's one of the legislative pressures which might change that.
Yeah, I mean, well, clearly the demise of the final salary pension scheme has, and because they're largely in runoff as opposed to the Canadian ones, which are cash generate, or which have got cash in, or the Australians or the Chileans or whatever, that is a big issue for it. But there's plenty of VC or private equity money ready for clean tech, so you can raise money for renewables. That is not a big issue. As I say, I think sadly what's happened is the biggest thing that's happened. It's going to really accelerate renewables in the UK.
Yeah. April has a question. Clive, do you mind passing it around? Sorry. Thank you. We don't have insurance on the microphone.
I was just going to ask that. What's the liability? I was just going to get hit in the head. Whoa, Heather. So, Martin, what's the next big thing that you have your eye on that we're missing?
Question.
I don't know. I mean, look, I quite enjoy what I'm doing at the moment. I'm also on the board of Glencore. And I mean, I've never seen money made as these commodity companies are making at the moment. I mean, we've got massive inflation coming through the system, I would say, is the big thing that I see if commodity prices hold at where they are. I mean, we're not speaking about 10% increases, by the way. I mean, we're speaking about 100%, 200%. And that hasn't been factored into, there's a massive inflation, I would say. Now, what that does for what we all do is going to be interesting. So it does show you still got to be in shares, I think, rather than bonds. You've got to be in private markets if you can access them. But yeah, it's going to be tough for the interest rate cycle over the next few years, I would say.
Does April need to throw that to anyone? No? We talked a little bit about vertical integration in the last section, and vertical integration seems to be one of these things that goes in waves, and so you have the Australian market with the I can't remember, the banking review looking at, and so that market's in a different part of the cycle, disintegrating, I think that Martin called it, and the UK market seems to be in a wave of vertical integration. Is that something you see happening in the wealth management industry? Is private equity money affecting that?
I mean, the two areas that private equity really like, as you know, are wealth managers and advisors. So there is a number of roll-ups going on in that sector. Yeah, I mean, and then the asset managers obviously want to go more directly to the consumer rather than be reliant on an intermediary for the business. So yeah, there's definitely vertical integration happening, and we saw that at Aberdeen with the purchase of Interactive Investor. Again, they want to go more B2C as opposed to B2B, which of course the asset management industry at the size that say Schroders and Aberdeen are at tends to be much more institutional and wholesale rather than direct to the consumer. So yeah, it's definitely happening. But I do say private equity like the advisor roll-up, and they like the private fund manager roll-up as well. So we're seeing a lot of that happening.
So back to that question about which parts of the industry will thrive, and which might, you might see, I guess, decrease in values. But would you put your money on advice or D2C? Is it some combination? Is that sort of the wrong thing to be looking at?
I think advice is going to become more and more necessary. So yeah, I would put money. I mean, the private equity guys are not stupid. I mean, they do tend to know what they're doing. So they really do like the advice market, and they love the advice market. They like the roll up of IFAs because they see they can professionalize it or whatever and make it work. So yeah, I mean, look, they know what they're doing. Wealth management, they like that business as well. So, yeah, again, it's about scale, though, in both of them. I mean, I'm always wary of scale. I think, as Martin Jennings said, once there's as many companies get disintegrated, I think, to use his vocabulary, as integrated. So I think that's what we see. I mean, in the big asset managers, we see the big getting bigger, and we see lots of boutiques. The place not to be in any of these sectors is the middle ground. You just don't want to be in that middle ground. You either want to be small and nimble, boutique in the asset management, if I use that word, doing something well. You can, and these boutiques are incredibly profitable. I mean, they can be making, 60, 70% operating margin if they're very, very good at what they do. And then you get to the big guys, the Schroders, whatever, of the UK ones, the Aberdeens, and even there, they're making say, should be, they're not actually at the moment, they should be making 35, 40%. But the place not to be is the middle ground, because as you move from a boutique up through the scale. You have to put more costs in place, risk, compliance, all of these sort of things, and then you get the benefits. So you don't get any benefits of the scale till you get to very big. So it all points to the middle ground being acquired by, and we're seeing that already with Janus Henderson, Nelson Peltz being in there. We're seeing it a bit with Jupiter, these sort of things. So they're in the uncomfortable space of the asset management industry at the moment.
So that's really interesting, because the examples you gave were mergers almost across different geographic regions to be able to bulk up. And my understanding was one of the rationales for Aberdeen Standard Life coming together was to be able to reach the US and other markets and expand beyond the UK. Is that part of your ambition?
Well, they were two very different companies. So Standard Life was very much stronger in the UK than Aberdeen was. Aberdeen was a much more global business, strong in the US and especially strong in Asia, great brand in Asia. And of course, Aberdeen had lost its UK retail place because of split caps in the early 2000s. So we were really out of UK, basically. We were a global business, strong in Canada, strong in Australia, strong in Chile, #1 in Chile, strong in Malaysia, all of these. So theoretically, it should have been a dream merger. It didn't quite turn out to be the dream merger it was supposed to be because of even though the two businesses were both Scottish-based, there was quite big cultural differences between a 200-year-old life company and a 35-year-old, whatever it was, asset manager, who the 200-year-olds thought were a bunch of thugs, that needed some sort of control. So, it didn't work out the way it should have. It could have been a brilliant merger, and it probably will be now. The new CEO is good, Stephen Bird's good, and he's doing all the right things. But he is going direct, as we were saying. He's going for vertical integration. My strategy would have been for more consolidation. So we have different philosophies, but I think what he's doing is good, and I think it'll work out.
Great. Any last question from the audience? No?
They want their drinks.
They want their drinks, exactly.
Yeah,
great. Well, thank you, Martin. I thought that was really, really interesting and pulled together some of the themes we've been talking today about private markets, about distribution channels, all sorts of different personalization. We talked a little bit about customization. So thank you very much. Can I have a round of applause for Martin?